Well, welcome. Really appreciate these guys for taking time out of their everybody's busy and got a lot going on. So really appreciate you guys hopping on. I think just initially, just so a lot of people probably know you guys and all that, but if we could kind of do an intro for each of you guys, and I'll kind of start with you, Chihiro. You're on my upper left, but if you want to just take a minute or two, just kind of give an intro and just kind of about you and what you do and all that good stuff. We appreciate it.
Yeah, thank you, Dustin and Hayden. My name's Chihiro Kurokawa, and I run the investment operations for my firm called ZT Corporate. We're based out of Houston, and we're business operators and investors. So usually, invest business investment firms or private equity firms of our size typically don't directly operate their portfolio companies, but that is one thing that we do. So it's kind of opposite of multifamily. You usually see as a multifamily operator expands in scope, they internalize, they vertically integrate, right? Ironically, it's kind of the opposite in the business side, where usually you see larger investment firms being more owners and managers than direct operators. In any case, for the last 20 plus years, we've been direct operators of various types of businesses. And so that's where all my effort goes these days. And prior to that, I was a multifamily investor, which is, of course, where you and I met, Dustin, many years ago.
Yeah, yeah. It was funny. I was going back and looking through 'cause what's neat about I guess Apple is you can kind of just go back and look at all the pictures with Chihiro. So I was like, oh, that's cool. So it's fun. Well, awesome. Well, Garland, kind of hand it off to you, and yeah, if you could kind of give a little bit of background on you, and if there's a way for people to connect with you, if you want to put that in the chat as well, that'd be great.
Sure. Hey, I appreciate it, Dustin. Yeah, my name is Garland Benton. I am the Director of Business Development at Direct Equity Source, located in Austin, Texas. I stay up here in the Dallas market, though. Yeah, just similar. Dustin met you, oh my gosh, what's that been? 10, 12 years ago, originally back in
Yeah.
multifamily. I've been in private equity from oil and gas to multifamily to single family, and now focused in self-storage and small bay industrial warehouses for about the last 7 to 8 years. So, our model is a little bit different than most. We focus on new construction, mainly in the Texas market, but we have exposure Florida, North Carolina, South Carolina also. So that's kind of our model that we've gone with the last 7 to 8 years, and yeah, looking forward to being on here and catching up with you.
Awesome. Well, sounds good. And Will, I'll pass it off to you. I feel like I don't know, we've probably been in the same room with you a handful of times, but haven't been able to chat a lot. But yeah, would love for you to kind of give an intro, and if there's a way for people to connect with you, please put that in the chat as well. And yeah, hand it off to you.
Sure, Dustin. I find it weird that we haven't met. I mean, I had to think about that for a while. It's kind of strange how this works these days.
Yeah.
But
Yeah.
yeah, my name is Will Crozier. I belong to a firm, a co-founder of CapX Ventures with Jason Sharp. He's my business partner. For the past 15 years, we were in the multifamily space in North Texas, deep value add. Made ourselves and our investors a lot of money. I retired in 2018 after selling several thousand units of that portfolio. Lived overseas and had a great time over there. Kind of felt an itch again to get back rolling and investing and building something. So I'm in North Texas, and we're doing primarily energy exploration, oil and gas. Also, we have a component of Bitcoin mining attached to that on stranded energy, which is a nice combination of things. And additionally, we are under construction of infill multifamily in Dallas, several hundred units with my partner Chris Mays. So largely oil, gas, Bitcoin mining, and also new construction infill in Dallas Fort Worth. Uh, Very happy to be here. Happy to talk about it. Thanks for inviting me, Dustin. This will be great.
Yeah, awesome. Well, yeah, excited to be here. Well, I guess I know everybody kind of touched on I guess, kind of, go back to you, Chihiro. So right now, and I know, you guys are involved in a few different things, and you have a pretty good sized portfolio and all that. I mean, what makes, car dealerships appealing right now? What's kind of there's lots of options out there. What kind of, makes this an attractive option?
Yeah, car dealerships are interesting. It's a somewhat a misunderstood business model in the sense that usually people just think of these as like retail locations, which obviously they are. However, really where you lock in greater margin and resilience in your business is in what we call like fixed operations, which is selling parts and selling maintenance or servicing vehicles, repairing and maintaining cars. And so what differentiates like a good or mediocre store from an excellent one is a really great operations team, which I think we all know that that's the key to every business, frankly. But post COVID, so through 2022, it was a really sweet time to be a dealership, and we experienced like significant margin strength on just retailing cars. And so that was extremely profitable for the industry, but it also concealed like laziness or poor operations. And so the margins are now still slightly above where they were in 2019, but they've compressed. And so it just puts more onus on dealership owners to be really good operators, doing like the unsexy things like managing inventory, paying the right amount for your technicians, your mechanics. If you pay too low, the quality is bad. If you pay too much, you're obviously spending too much. And so optimizing like throughput, how quickly are we getting cars back to the customers? Are we minimizing or eliminating rework, somebody coming back for the second time because it wasn't fixed? It's all that like day-to-day boring stuff that separates a great store from a mediocre one. So all that to say, I think what's compelling is the opportunity to find stores that have some sort of operational upside and then implementing better processes, systematizing things in order to squeeze some more margin out of that business. And you don't necessarily have to fire people or sell assets in order to do that.
Gotcha. Real quick, I'm just because I have no idea. Do you go through a business broker? Is it, how do you, is there, I mean, there's not like an MLS for car dealerships, or maybe
Yeah, so
there is.
that aspect of this industry is actually very similar to multifamily in that the
Oh,
dealership specific brokerages control the deal flow. Like
yeah,
we just got a deal off market, but it's just like getting an off market deal in multifamily. Like,
right.
you know,
Okay.
exact same dynamics. Now, generally in other businesses, a lot of deal flow, there's more diversification or diversity of deal flow, meaning you might get it from a business broker, you might get it from an investment bank. That's a very common channel. And there's like good old just like direct marketing, talking to business owners and trying to trade a deal without an intermediary as well.
Gotcha. Okay. Garland, what about you? What makes self-storage and all that an attractive option right now?
Sure. It's a great question. Yeah, I think a lot of us, all of us, have probably used storage at some time in our life. Everyone's familiar with it, but it's just not really a sexy investment. It's just kind of predictable and boring. You don't have the wild market swings. But, as my investor base, gets older and looking forward to retirement, it fits a great niche because of those reasons. It's just the predictability of it without the wild, ups and down swings that some of the other markets can have. If we want to be specific about why right now we feel building new construction makes the most sense in this exact environment. There's some studies out there of varying percent, but They're looking at new construction deliveries are down between 30 to as much as 50% negative over the last couple of years. And because of the higher interest rates, you don't have near as much new construction. So there's an opportunity there. We just continued on through that entire phase. As I mentioned earlier to you, we're building 8 properties right now simultaneously in various markets. So we didn't
Wow.
slow down when interest rates got higher. We have a different model. So we just kept everything the norm. And I think that's what's creating, though, is an opportunity to deliver into the market later this year and over the next 2 years, where you're just going to have a lot less new inventory coming online. So, yeah, if we want to be specific about right now opportunity, I think that's probably the biggest one out there is less competition over the next couple of years.
Okay, gotcha. And do you guys, is your plan kind of, because I know you mostly only build, are you building and then you fill it up and then sell, or you try to hold, or what does that look like for you guys?
Sure, that's a great question. There's all different models. Some people build with the intent to hold these things forever in cash flow. That's not our model. Ours is more of a time value of money. We really consider ourselves, our sponsor, as a merchant builder, meaning we are building with the full intent of selling within a 3 to 5 year time horizon. So yeah, typical is in your multifamily world is all based off occupancy, right? Net operating income, and that used to be the norm in ours. And what we've seen really change the dynamics over the last couple of years is you've got a lot of private equity firms now breaking into this space, wanting more exposure in this space as opposed to residential, and it's just completely changed everything. I could go on all day, but just, I mean, give you an example. We sold some properties last year that were at zero occupancy. We literally just got our certificate of occupancy. They come in and wanted to buy them. They just want to do their own branding, their own marketing, their own strategy. They wanted to control a market. So we made several sales that had no bearing on what our occupancy and net operating income was. So that's really changed the dynamics since you've got different players, getting into the space. But
Wow.
that's
Okay.
that's our model is to build it, ideally fill it up 90+% occupancy and look to divest in that 3 to 5 year window.
Yeah, gotcha. Okay. Well, what about you?
Yeah, sure. Well, just a quick background. I was born into poverty, rural Idaho. I also did a stint of that, 200 people in the town of in rural Kansas, southeast Kansas, 8-man football, 11 people in my entire class, all of that. I come from no money. And so ever since I got into business, I needed to really, really move the needle. I had to do something exaggerated to hit returns that would be meaningful. It wouldn't matter if I made 10, 15% on my money when I had no money. I had to grow and build. And so pretty much our investment thesis has been to create deals that could do that, not just for ourselves, but for our investors, people who only had $25,000 investable, $50,000 investable, do something for them that would actually move the needle and help to change their life. So we did that in multifamily, value add all through, the 20 teens. And we continue to do that today. Currently with our energy deals, our oil and gas, we're really looking for asymmetric bets. Basically things that, you hit it right, it can go to the moon. If you don't hit it, you don't lose your shirt, you don't lose everything. The goal is to limit losses the best way that we can possibly do, and then let the winners run if we really, really hit it. And it's been an interesting go. Uh, we've had some oil and gas fields that we've purchased basically to renovate them, similar to what we do in multifamily. Those have gone so-so. I mean, I think that the first one that we did like that was like around a 92% return in around a 2 year time horizon. Since then, we've been, actually drilling, and that's where we're hitting what much closer to our performance metrics. And we've been fans of that, and we're going to continue to do that. And how we do that is sort of positioning ourselves between the small mom and pop operators, which are plagued with issues and scams. Oil and gas in Texas is mind blowing how rough it is. The people are as you imagine, as you've seen them on TV, as you've seen them in the movies. They're as rough and uneducated and as unprofessional as you can imagine. Some of them blow it out and make billions, 99% do not. And then you have the huge institutional operators. And we're doing our best to thread right in between them. Too big to compete against the Billy Bobs out there, and then much too small to give any headache whatsoever to Exxon or any of these guys. So that's kind of our bread and butter, is operating between those two, and utilizing things like flared gas or stranded energy to produce Bitcoin as well. So we're really doing three commodities: oil, gas, and Bitcoin, and it's been phenomenal so far. We're going to keep on rocking and rolling it. We're not currently raising any capital. We have a fantastic investor base, but we make them very, very happy. But we're growing, so we'll see where it goes.
Awesome. Yeah, sounds good. Well, I guess Will, just real quick, I know oil's been, shooting through the roof and all that. I guess how does that, make you excited? Is that, I guess how I guess yeah, just how is that affecting your business, or how is that affecting things for you guys, or your investors, or just curious.
Sure. Well, I saw the meme last night on one of my industry. It was the Great Gatsby, and that's Midland, Texas, right now. Just these massive wild parties. Of course, no one really minds in the oil and gas if it hits 120 like it practically did last night. At
Yeah.
the same time, stability is a good thing. So, if it would settle
Yeah.
down right around 90 and just stay there for a while,
Yes.
that'd be okay by us.
Yeah.
In general, it puts a lot of attention on it, and we'll take it. But we were operating just fine when it was much lower months ago. So we'll take the upside where we can, and we'll run with it. But it's not what our business is built around.
Yeah. Yeah. Understood. Awesome. Sounds great. And then I guess as far as I don't know how it works on the oil and gas side, so kind of sticking with you, Will. You know, is there I guess for new opportunities and all that, it's kind of word of mouth or brokers, or what does that kind of look like as far as you guys looking for new opportunities for your investors?
Yeah. So kind of what I was saying about trying to rise above the mom and pop people, but below institutional. We have seasoned operators that only deal in their backyard. They're not off wildcatting, looking around for new opportunities. It's like they've known about these opportunities for the past 30 years, or
Uh-huh.
the old dogs. They know where it's at, and it's really just a function of getting the capital stack put together. So that's where we join together with them. They know the opportunities. We just have to marry it together with actual legal structure that makes sense for our investors. Dot every I, cross every T. That's where oil and gas gets into so much trouble. So we're just trying to clean it up and package it in a way that's palatable for our very seasoned investors, along with the operators in the field.
Okay, gotcha. And are you guys, I guess maybe with oil kind of being on the higher end, maybe I don't know if more of those opportunities are potentially coming over for you guys over the next few years, or if the higher oil is going to make it more challenging. But I guess just kind of curious about the space that you're in, and kind of where are you seeing your business going for the next 3 to 5 years.
So we're not scaling just to scale. We're scaling as it makes sense, as we have capacity, as we have bandwidth to do it. So a lot of times that is the conversation we'll have every week. Are we ready? No.
Yeah.
Let's chill out for a while. Let's solidify things, strengthen here, strengthen there, bring in some more people. So we're not rushing to scale, but we certainly are scaling. So at our own pace, and as it makes sense, we're growing, and we'll put more syndicated deals together.
Gotcha. Okay. Awesome. So going back kind of around to you, Garland, you guys are, you're developing 8 deals right now. And I guess how, and you guys have been in business a long time. Are you guys, still seeing plenty of opportunities for you guys for the next, 3 to 5 years to kind of, continue to grow? Are you guys, yeah, I know you're focused on Texas, but you're also, it sounds like you've been, North Carolina, I think South Carolina, I know Florida. Are you guys looking to expand to other states, or what was kind of the next few years look like for you guys?
Most of the focus is Texas. Obviously, we go where the growth is. Hard to compete against that. We really try to stay within those states as, most of our existing relationships and construction teams are located in these places. People that we worked with, my operator's been doing this since 1993. So, 33 years, building these facilities. They've kind of have a cookie cutter model down with the climate control. So really not necessarily looking at any states outside of that right now. We have enough inventory in-house to definitely, develop over the next 5 to 7 years. Because, in the commercial world, you just don't go buy a piece of land, today and start developing it next month. We're out buying, land well ahead of time, going through the permitting, zoning, phases to even get it to the shovel-ready point. So, our partnership doesn't even see it until we're at that point, or, we'd be sitting on dead money for sometimes a year and a half, depending on, where you're at. Like our Florida properties, they take about 6 months longer to develop than Texas properties. So you just have to build that into the financials as an expected, timeline with the permitting restrictions there. So, yeah, that's kind of our focus, and we've got a large runway here, for the next 5 to 7 years easily.
Gotcha. Is the more time in Florida, the permitting process is just a longer time period there, or there's any other issues there?
It's just slow. Yeah, we're not really building anything coastal, so we don't run into anything like that. It's just, going through ever since COVID, everything slowed down on
Oh,
that, and it's just really never recovered 100%. But that's just part of Florida. I mean, that's not a bad, downside. An extra 6 months built in. It's just seems to be slower than, Carolinas or Texas in comparison. But yeah, again, that's a part of it. Mostly is Texas focused. Again, Austin, Houston, San Antonio, and not in the major downtown, metroplexes. These are on the outskirts and in the path of growth, such as Georgetown, or
right.
Cibolo in San Antonio. You're just kind of Huffmeister near Houston, just kind of right on the fringes where there's tons of new residential communities going up. So you still don't have the permitting as if you were in downtown proper, if that makes sense.
Yeah, yeah, got it. Okay, understood. And Chihiro, I guess for you, what is, kind of the next few years, 3 to 5 years? I guess any potential, issues with deal flow, or just, kind of curious your thoughts on your business moving forward.
Yeah, we are very narrow and deep in our two asset classes that we focus on. And by default, we have to be, right, because we operate these businesses. We're always talking about potential new verticals to enter into. And the challenge with that is you're getting into a new business that you may only know tangentially or not know at all. And so partnering with the right operator is absolutely critical, and have them structured so that they have skin in the game, right? And so we are considering entering into at least one new vertical, which I'll say is similar in a lot of dynamics to like selling cars. It's selling equipment of a particular type. And, in order to not get ahead of ourselves, we are going to hire a proven operator with that's gone full cycle, that has grown, scaled up these types of businesses. They're going to be compensated or incentivized properly. And also, we're not going to do a big deal. Like, we're not going to do like $150 million deal. We'll probably do a 50 or a $30 million deal so that we're not raising a significant amount of capital on a brand new deal. And assuming that goes well, then we can scale. So macro wise, we're looking at where the growth is, and then micro wise, right partner, right deal size.
Are there on the dealership side, are there certain parts of the country that you like to be in? I don't know if, on the multifamily side, it's, you're looking for, just landlord friendly and all that. Are there kind of similar things that you guys look for as far as dealerships?
Yes. So those overarching dynamics of you want growing household formation, growing job formation, 100% like we're very well correlated there in terms of what you look for as a multifamily operator and what we look for as a dealership owner. More specifically, what we really like is chasing deals that have a succession crisis. So multifamily, um, yeah, it's not easy, but like, I was an analytics guy at Toyota when I partnered with you, Will, on my very first deal, and you and Jason helped show me the ropes, right? So with some effort, like that's feasible in multifamily, but like operating a dealership, for example, is quite different, a lot more complex. Every dealership is five fairly different businesses in one. You got used car sales, new car sales. Those are actually two different kind of products, really. And then you got parts, you've got service, and you got finance and insurance. So on the one hand, you're selling used cars or new cars. On the other, you're selling like financial products that are can be difficult to explain to somebody. So all that to say, it takes a lot of time to develop proficiency to become like a general manager of a dealership. And the reason these succession crises happen is like if my parent is a dealership principal, I know that he or she's working 363 days a year. It's like very common 12-hour days. I don't want to get into that. I'd rather get a liquidity event and have dad sell the business. And so that's
Mhm.
overwhelmingly the case. And so that on a more specific level, as far as deal identification, like those are opportunities that we really like exploring when it's a family-owned business that doesn't have a succession plan.
Awesome. Um,
Cool. Yeah, no, I appreciate you guys sharing that. And we've got quite a few, investors on the call and it's an interesting, at least for our business, it's been an interesting time over the last few years. And I know, spotting risks and understanding those are on every investor's mind out there. So I may start with you, Will. What are some of the biggest risks investors should be looking out for when entering into or thinking about investing in an oil and gas opportunity?
I think interestingly, it's very similar to what I've experienced in the multifamily side, and less often it's about the deal. It's not about the investor being able to properly underwrite the deal. It has everything to do with who are you doing business with. I mean, I can scream that again and again and again. If you got the wrong operator and the best possible deal in the world, it's still going to fall in its face. And if you got a terrible deal, but you got the right operators, probably you're not going to lose money and you're going to maybe even eke out some profit on the thing. So, as simply as I can and state and not take too much time, it's just make sure you're dealing with the right people, know how to underwrite the people that you're dealing with. Don't just don't just wire the money and then too often we're the ones holding up our hands and hitting the brakes with people like just hang on a bit, there's a proper way to do this. We'll have the right paperwork in your hands and tangentially make sure that you're accredited. There's some people that miss out on all kinds of deals because they're not accredited. And how many times our SEC attorneys, probably all of us, say do not deal with non-accredited people, and that's a bummer. So I would just leave with those two things.
Mm. Yeah, no, we like to say in our business, we're not in the apartment business, we're in the people business. So, I think that applies. I know Chihiro, you mentioned that too, but yeah, I'll go to you, Garland. What about you in the self-storage, especially in development too? That's I know there's a lot of risk involved with that too, but if an investor is looking at investing in one of your deals, what sort of risks, especially on the horizon, maybe as the industry's changed over the last few years, what should they be looking out for?
It's a great one, and I'm going to echo probably what Will said. I think it works the same in every single investment, whether it's multifamily, oil and gas, because I've done these for 25 years, and it really all comes back, in my book anyway, to two of the main factors that during due diligence I think can't be overemphasized. And that's who are you doing business with? How many deals have they actually done and show you those results on? And then how much skin in the game do they have? And I think investors don't ask those kind of questions near enough. They get caught up in their pro formas and the who smooth talking salesman that's trying to get them in the deal, and they don't really dig into the details on who's doing business. I mean, I'll just give you an example. I have personally consulted with a company that built a new storage facility in the best location you could probably ever pick in our lifetime, like right across the street from massive D.R. Horton development. They were the only game in town, and it absolutely fell flat on their face because they didn't know how to operate the property. Anybody can, we could pull our money together and go build a storage facility, right? But if you don't know how to market, you don't know how to operate it. I've seen things like that fall on their face. Again, it's not even necessarily about location. It's does your partner have the experience? How many times have they done this? And again, my biggest deal is how much skin in the game. I give you an example. My sponsor and operator, they're putting in between 20 to 25% of the actual cash on every single deal. And in the syndication world, regardless of what sector, I mean, I think that stands out. Not very many operators put a lot of cash in at the same terms, as the investors. And to me, that's two of the biggest things that I think all investors need to be asking.
Yeah, that's a great point. We always like to say we like to eat our own cooking. So, um,
Exactly.
yeah, definitely great advice there. Chihiro, I know you already kind of echoed the team aspect and everything, and you touched on how maybe the margins in the auto business have been coming in. So maybe you can touch on some of those other variables that you see out there, that how the industry has changed a little over the last few years for people that are maybe looking at, or maybe they want to go off and buy their own dealerships too.
Yeah, it's harder. So it's getting harder and harder to be a lazy operator. As I mentioned, margins are still elevated from historical level, and I'm talking about retail margins on new and used cars. But um, I used to think maybe it was going to remain at an elevated level, and that's these margins are largely a function of the discipline or lack of discipline by the manufacturers, the Toyotas, Hondas, Fords out there. Um, Regardless of those details, if margins are going to continue to normalize and then return to like an inflation excuse me, a 2019 type of level, then what's going to be important is, well, let me provide a specific example. So we did at two times we have replaced the operating partner, the president and CEO of the dealership business. And the reason that happened is each time we were leveling up, but in one instance, our operator wasn't, it was kind of penny wise, pound foolish in that we were just paying as little as we possibly could as far as mechanics were concerned in our shop floors because we want to reduce OpEx. But we had high rework rates. We had poor throughput. Repairs were taking a long time. Obviously terrible for business long term. So that was something that we realized was an incorrect approach, or at least not an approach that we desired. Another area that we improved upon with that change from an old operator to the current one is like we had a ton of money tied up in inventory. Like, why do we have two transmissions sitting in the parts room? Like, we should have zero transmission sitting in there. What is that? Like $2,500 part that's just sitting there. When are we going to turn that thing? And the more inventory you have, the more inventory disappears, just walks off. So it is it's death by a thousand paper cuts in this business. There's not like one big thing like, oh, I did this one marketing thing and it changed everything for us. No, it's doing that and managing this and managing that and running a great finance and insurance program and all these different levers that make up this relatively complex business, which is an auto dealership. And that's the difference maker.
Chihiro, just real quick, on because I know you were talking about you guys kind of have five different businesses that, for dealerships and all that. Is there one that kind of, you know, makes up the largest chunk of the business, or what does that kind of look like for you guys?
Yeah, so I want you to visualize a dealership business like top line revenue versus like gross profit, the actual bottom line. On a revenue standpoint, new car sales dominates. So these are really high revenue businesses. It's you'd be surprised that some dinky little dealership somewhere in a small town is making $100 million a year in revenue. And 65% of it might come from new car sales. But then what drives profit the most, especially in the current climate, is fixed ops, what we call selling parts and service and maintenance. So parts is can be something that isn't front of mind, especially as just like a layperson. But if you think about it, it doesn't matter. We would love for you to come to our GM dealership to get your GMC truck fixed. But if you're not going to do that and you need a new radiator and you're doing it at Joe's Muffler Shop, they're still buying GM radiators from us, right? So maintaining those relationships, getting them parts quickly, all that type of relationship building within the community is critical in order to effectively drive that business, in addition to some of the things we discussed, like inventory management and whatnot. And the other piece is maintenance. And so um, the outsized profit drivers are part sales and maintenance. The outsized revenue driver is new car sales. And so it's very common for maintenance to generate a lot more profit than the new car sales department does, even though they're dramatically different from a revenue standpoint. So it's just a very high gross margin business to be in the maintenance side of things. So you got to treat people right. You can't just have crappy coffee. Like you need great refreshments. You have to have amazing salespeople who know how to sell, but they're not pushy, they're not greasy. You got to get jobs done right the first time. You got to get them done quickly. It's all that type of stuff. And then community partnerships, hosting events, sponsorships, the local baseball, the youth baseball tournament or whatever, sponsored by Jones Chevrolet or that type of a thing to keep yourselves top of mind.
Got it. Yeah. Chris had a quick question. We'll just kind of stick with you, Chihiro, just for a second. How do you expect the growing market of EVs and their greater likelihood to adopt direct sales models to impact the traditional, car dealership model?
Yeah, so we love EVs and we're excited about it. We do expect the Chinese like Xiaomi, BYD, we think it's inevitable. They're going to have retail outlets here. They're going to have dealerships. It's definitely not happening within this presidential administration, but it's going to happen at some point, and we want those stores. Um, when it comes to direct sales versus like the traditional franchise model, the franchise model is very institutionally kind of, for better and for worse, it's just built into our society. And so when BYD comes in here, and we think it's going to be a dealership based model or something that is going to differ from that direct sales model that currently exists with some of our EV manufacturers today. That is speculative, but generally we can expect that if we're going to let them come in and start taking market share from existing American legacy businesses, that whatever administration, presidential administration, is going to extract some sort of concessions at that point. We're also still bullish on the dealership business because EVs are going to be a very important part of transportation, especially with this amazing tech that the Chinese manufacturers are rolling out. However, we don't think GM is going to disappear, Honda, BMW. We think those manufacturers will continue to exist. So, and that's going to be regardless of what the product mix is, meaning BMW. I'm making this up. Maybe 5% of the cars they sell today are EVs. Whether that drops to zero for some bizarre reason or goes up to 65%, we think BMW is going to exist. And so we're long or bullish on BMW and Kia and Mercedes-Benz to achieve a whatever the right product mix is for EV versus hybrid or EV versus combustion engine vehicles. So we're here for that. And regardless of what that EV product mix ends up being ultimately for cars sold here, um, we just like the fact that we can have the exclusive seller of Mercedes-Benzes in the Fort Walton Beach market.
Yeah.
And and that's what we're buying into long term.
Awesome. Sounds good. Will, I'll turn it over to you. So is as far as I've been in a lot of oil and gas deals, so just some of your some of the stuff you had mentioned in the beginning really echoed with me. And so how can someone are there any traits or anything that you would suggest that like kind of separates good operators from not so good or just I guess for the audience just kind of any tips or tricks or anything that you've kind of learned about since you've been in this industry?
Sure. I like sort of the crossover or hybrid operators, the people who weren't necessarily born and raised in oil and gas. And, since they were 8 years old, they've been out in the field. That's a good story and it resonates. For me, we've had less success with that type of a person, and we've had more success with a CFO who was in the oil and gas industry, learned numbers, how to do financials, how to, properly update and report. And then they physically transferred into the field and learned that. I strongly prefer that kind of a model, and that's where we've had better luck, is people who can carry the professionalism, who know the financials, know how to do projections, and learn the field. Learn how to communicate with the guys in the field, the drilling crews, the makeover crews, all of that. So that's who we've gravitated towards as capital partners is people that fit that profile. Um, I don't think I have more to add than that. Is been sort of our go-to so far.
Okay. Yeah, I gotcha. Yeah, I've invested with quite a few different operators and it's been interesting. I guess just for we're multifamily operators and so and we try to take a lot of pride in communication and just follow up and and all that. And so it's been interesting when it's been a while, but when I invested with them, it's like I get no updates, like nothing, and then trying to pull anything from them has been challenging. So
A
anyway.
scam. It's all a scam. I swear.
It is.
Insane to learn that.
Yeah, yeah, it was interesting
Hey, I'm
experience.
an LP in an oil and gas deal, and it yeah, it feels like borderline scam. I'm with you, Will. I should have invested with you guys, but you
Yeah,
live and you learn, man.
yeah, yeah. Well, Garland, I guess kind of similar question. There's a lot of different. I don't know how many self-storage people there are, but like I see, people pitching and all that.
Mhm.
Would love to just, how to, I know you guys been doing it a long time and have a, massive portfolio and all that, but is there anything that I guess you could, for the audience, kind of, hey, look for this or look for that, or just, I guess I know, I really, I'm sure it resonates with everybody. The fact that the founders are investing so much into every deal is obviously super attractive. Everybody wants to see skin in the game. So, but if you have any other kind of words of wisdom, that'd be appreciated. So,
Yeah, I mean, I think again, kind of what Will touched on. I mean, I spent, 15 of my 25 years in private equity were in oil and gas, and it's uncanny actually. the type of they're not all scams, but let's just say over promoted, overpriced oil and gas people have evolved and see them in the storage space. So it's really the same kind of MO as overoperate, overcharge the investors and the cost of the properties. That I think that's one of the most things that I've seen is, those oil and gas guys that go drill $1 million well and charge investors $2 million for it. They're making money regardless of the outcome. And those are out there in storage that you got to look out for. They're going and building, we do videos and talk about and share the construction costs. Like here it is black and white. We paid $97 a foot. It's full disclosure. I see it all the time out there, guys going and building, what cost $10 million facility and charging $14 million. They're pocketing $4 million before the thing ever even gets up off the ground. And it just reminds me of, oil and gas community and, the people that are out there. So just always be mindful, ask for the cost. Again, it's your money as an investor. You shouldn't be, nervous to ask these kind of direct questions, right? Like, what are the actual costs? Let me see it. I want to know up front, how are you guys making your money? I always ask that. I know we talked earlier about due diligence and history and how much skin in the game, but also, what show the transparency cost and ask them, how are you guys making money on this deal? Is it on their operation side? Are you going to charge a flat fee? Is it, based on occupancy? Is it, a fee up front? Those are things as an investor you need to really look at the fine print and ask the tough questions.
Yeah, that's great advice. Yeah, transparency is definitely key there. I've got one more question for you guys, and definitely want to leave some room if there's questions from the audience. So if there are, feel free to drop them in the chat. But I'm just curious. It's kind of a two-part question for because a lot of our audience is multifamily specific. So we've got a lot of multifamily investors on the call and people that are going to listen to this recording. So the first part of the question, I'll start with you, Chihiro, is what are typical returns for your offerings? And then how does that, let's say, how does it complement a investor's portfolio, maybe if they're more heavy in multifamily?
Mhm. So we like to offer a range of types of investments. So we do have common equity raises, particularly on the healthcare side, that I would say is probably most similar or going to be most familiar to people who are experienced as LPs in multifamily. So there's a 9 to 12% preferred return that's distributed quarterly, and then an upside component based on the liquidity event, which is most likely going to be an asset sale or complete portfolio sale of some sort. So we have deals like that. And then we have, and then I would say most of what we have, maybe 60% of what we offer is much less risk than that. So, but much more consistent. So very income oriented type of deals that might generate a 12% yield or somewhere around there, double digit yield that's distributed monthly. And that has you lower in the capital stacks relative to common equity. So you're not taking on as much risk. And so it's a good hedge for something that might be more risky, like if you're in a bunch of multifamily syndications or other common equity investments, or you have a lot of public stocks in your portfolio and you want to hedge that with a good yield and get a consistent return off of it. It's a good fit for that. Or people who are on fixed incomes, people who are retired and just want a predictable yield. So broadly speaking, those are the two categories for us.
Gotcha. Awesome. Yeah, appreciate you sharing. I'm going to go to you next, Will. So again, kind of same question. What are typical returns that you're seeing out there? And again, how does that potentially complement maybe a real estate or multifamily specific investor's portfolio?
Yeah, like you mentioned, most of our investors, even in the oil and gas, are multifamily investors. That's how we found them. That's how we won a relationship with them. So that's what they're really looking at. I myself am heavily invested in multifamily as well. So the question you just asked is one that I ask my own personal finances all the time. The deals that we're doing, both in infill multifamily and in oil and gas and the Bitcoin mining, if there's not a solid path to doubling your money within the deal's life, we don't touch it. So we typically will look at deals sort of on the 3 year horizon, sometimes a little bit longer, sometimes a little bit shorter, but just roughly 3 years. If we're not doubling your money, we're not really going to put it out there. Uh, we do a lot to water down our projected returns because they just, you know, they look pie in the sky, and also at times they do turn out to be pie in the sky. So we have to normalize them somehow. But roughly speaking, yeah, double your money in 3 years. And if it doesn't do that, we won't look at it. On the other side of that, we take very, very careful time and consideration into not losing anybody money. So it would be really a bummer if we're able to do one deal and we double your money, but the next three we lost all your money. So that doesn't really pencil out very well for anybody's portfolio. So on the flip side of that, we take careful concern to have several exit paths that do not end up losing anybody money as well. So that's definitely in our models. So I think I've answered.
Awesome. Yeah, and then I'll turn to you, Garland. I know self-storage is similar to multifamily, but obviously there's different components to it. So I guess, one, again, what are you seeing in terms of returns? And then why would somebody want to do, if they're a multifamily investor, why would they want to add storage to that portfolio?
Sure. I mean, straightforward. Just black and white numbers is I think we now have my sponsor has 95 or 96 completed full cycle projects. So again, pretty thorough history, and the average return on those was between a 19 to 29% internal rate of return on every single one. Overall equity multiple would have thrown you right at about a 2.5 to 1 return over an average 4 year lifespan. So that's the black and white of historical what have they shown. And I was explaining to Dustin earlier, we got away from the differences versus a multifamily single property syndication. That's how we used to do our storage, right? Just one at a time, one after another. Now we've really streamlined things, gone to what I consider like a fund model, whereas like our current fund has 22 facilities in that particular fund. But it's more like an evergreen model in that this isn't, if somebody were to ask me flat out, how long, hey, how long am I into your project? The answer is however long you choose to be in it. We offer an exit strategy after 24 months of you being in the project. You can get out anytime you want. So we have liquidity that we offer to a traditional syndication. And then how we get revenue is two different streams of revenue. We pay a fixed 12% annual dividend while you're in the project each and every year. And then the other source of revenue is just like you would do from the multifamily at the liquidation or sales event. That's going to happen somewhere in that typical 3 to 5 year time horizon. So you get those two different forms of revenue coming to you. And if you want to, stay on the ride with us the next 7 to 10 years, great. Love to have you. If you need to get out and you need your cash back after three, you've got that ability under our new structure. So it's an ongoing project, if that makes sense. And then why would multifamily investors? I would say probably better than 65, 70% of our investors are multifamily. That's just, everybody that does syndication seems to have some exposure, in the multifamily arena, because it's very similar. The reason that they would gravitate towards us is just simple diversification into another market. A lot of people aren't aware that you'd look back over every single economic downturn that we've had over the past 30 years, self-storage has been the least affected. It's performed better than all the other real estate sectors. So it's just a diversification. I think in a portfolio, they need multifamily. They need oil and gas for some tax benefits that associate with this, and storage just for that long-term predictability without the ups and downs of the economic cycle. So we do the cost segregation studies. I'm not sure if you guys do that on your
Mhm.
apartment complexes. A lot of people do. So we do the cost segregation analysis. So that the bonus depreciation flows through at the partnership level. So for guys that are in a lot of other, real estate deals, that's beneficial because they typically have income coming in from those that they want to shelter some of that income through those tax benefits.
Awesome. Sounds great. And Chihiro, I had a real quick question, then would love to have everybody just kind of give some parting words and all that. When you guys buy a dealership, are you guys buying the buildings and all that too? So do you have cost tag or what was that?
Yeah, we typically do not. We just buy the opco. We
Okay.
want to buy the business that's generating the cash. We have owned real estate before in all of our asset verticals, but we're especially on the equity side, we're trying to hit a 20 plus IRR net to our investors. And
Yeah.
when you have a triple net deal embedded in that that's yielding 6%, you're just dragging your own returns down. So we'd
Yeah.
rather sell that or not own that land and the dirt, and just free up that capital so we can buy HVAC units or whatever, repaint the
Awesome.
dealership. Yeah.
Yeah, sounds great. Will, we've just got a few minutes left. If there's any parting words or best way to for people to get a hold of you.
Yeah, sure. This has been fun. Thanks for inviting me out. I liked Garland plugging my holes that I missed on oil and gas and how it fits into a multifamily real estate portfolio. Certainly, there's some tax advantages there as well. And I joke around with my multifamily brokers that I see all the time out at a happy hour or whatever, and they go, so how's life over in oil and gas? And I'll usually, grab them with the zinger. Oh, it actually cash flips. It's pretty interesting. kind of friendly rivalry or banter there. But yeah, cash flow is the name of the game in the oil and gas industry, which is a bit different than the multifamily and how we structure, especially our value add deals, which are long delays before you get paid, or the ground up construction, which you know you get paid on the last day kind of thing. So it fits in well there. Um, I put my contact in the chat box, but Will at CapX Ventures, CapXVentures.com is a great way to get me. I'm all over social media, usually trolling and being rude, and that's why I, don't get very far on social media. But happy to chat with anybody. Not raising capital right now, but we'll always be doing something in the future.
Awesome. Garland, you want to any parting words and just how people can get a hold of you?
Man, I just appreciate you and Hayden having me on. I think when you really look at your most successful clients, right, and your most successful ventures, I think a portfolio that works the best has a little bit of everything in it. I'm not one of those to say put all your money in storage or put it all in this. It's like I've personally seen, I have some very, very wealthy clients from car dealerships. So, I mean, I know that's a very, very lucrative play. Oil and gas, I've seen both sides of it. So I just urge, really people to have a diversified portfolio because there's actually a benefit in each segment of what they bring to the table. That's a little bit different. And during different economic times, I think they balance each other out because they're all going to have peaks and valleys and to be in all of them, makes the most sense. But I put my information in the chat. Feel free to reach out on email. It's just Garland at directequitysource.com, and love to take anyone interested to see some of our properties we're building across Texas.
Awesome. Sounds good. And Chihiro?
Well, I don't know if that was a personal insult, but it hurt me when you said multifamily not cash flowing because it took me getting out of multifamily to find cash flow, which is not to say, you know, anything generally about multifamily, but I did value add deals principally as a GP and LP, so I'm very familiar with that dynamic. In any case, my parting words would say, focus on the journey, not the destination. I've been punched in the face. I've gotten back up. And you cannot make money without risking money. And so I've learned a lot. I've grown a lot as a human, and you do have to take risks. But having said that, amazing gems from each of you about like how to mitigate risk and how to find the right people to partner with or invest with. So thank you all for your insights.
Yeah, and your information's in the chat, and just really appreciate all of you guys hopping on here, and appreciate everyone that was taking time out of their lunch to join us. We'll this is recorded. We'll send it out, all that. But just yeah, thank you, Chihiro. Thank you, Garland. Thank you, Will. And look forward to talking soon. See you guys.
I
Thank
appreciate
you.
Cheers.
it. Thank you,
Bye.
Dustin.